Welcome to Simplified Whispers. Today, we're diving into one of the greatest investment books of all time, The Intelligent Investor by Benjamin Graham. This book is not about getting rich overnight, but about mastering the art of rational, long-term investing. Graham introduces value investing, risk management, and the margin of safety, concepts that have guided legendary investors like Warren Buffett. If you've ever wanted to invest wisely and avoid speculation, this book is your roadmap. Stay with us as we break it down in the simplest way possible. Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. Benjamin Graham begins by establishing the fundamental difference between investing and speculation. He defines investment as a process that, through thorough analysis, ensures the safety of principal and provides satisfactory returns. Anything that does not meet these criteria is speculation. Graham argues that many individuals who consider themselves investors are, in reality, speculators, as they make decisions based on market trends, news, and speculation rather than fundamental value. He warns against the gambling mentality in the stock market, where people try to profit from short-term price movements rather than evaluating the true worth of a company. The chapter introduces two types of investors: the defensive investor, who seeks to minimize risk and effort while achieving moderate returns, and the enterprising investor, who is willing to put in more effort to achieve higher returns. Graham emphasizes that both types of investors must follow rational principles and avoid being influenced by market hype, fear, or greed. He also highlights that the stock market does not always reflect the real value of companies in the short term. But in the long run, rational investing based on intrinsic value tends to yield stable and rewarding outcomes. The chapter sets the stage for a disciplined, analytical approach to investing, which is the foundation of Graham's philosophy. Chapter 2. The Investor and Inflation. In this chapter, Graham explores the impact of inflation on investments and how investors should position themselves to protect their wealth. Inflation, or the gradual increase in the cost of goods and services, erodes the purchasing power of money over time. Many investors assume that stocks always serve as a hedge against inflation, but Graham warns that this is not necessarily the case. He provides historical data showing that stocks do not always perform well during inflationary periods, contradicting the common belief that equities always offer protection against rising prices. Graham suggests that a balanced investment strategy is essential to withstand the effects of inflation. He explains that common stocks can provide some protection, but only if they are purchased at reasonable prices and belong to financially sound companies with strong earnings records. He also discusses other asset classes, such as bonds, real estate, and gold, as potential hedges against inflation, but warns against speculation in these assets. His core message is that investors should not rely solely on any single asset class to protect their portfolio from inflation. Instead, he advises maintaining a diversified portfolio with carefully selected investments that can withstand both inflationary and deflationary environments. Chapter 3. A Century of Stock Market History. The Level of Stock Prices in Early 1972. Graham uses this chapter to present a historical analysis of stock market performance, focusing on how markets fluctuate over time. He emphasizes that the stock market operates in cycles of booms and busts, meaning that investors should never assume that stock prices will continue rising indefinitely. By analyzing over a century of stock market data, he demonstrates that market conditions can change drastically due to economic, political, and social factors. One of the key lessons from this chapter is that market optimism and pessimism often drive prices away from their fundamental values. During periods of economic growth, investors become overconfident, leading to excessive stock valuations. Conversely, during recessions, fear takes over, and stocks often become undervalued. Graham warns against blindly following the crowd mentality that causes people to buy during market booms and sell during crashes. Instead, he encourages investors to take advantage of market fluctuations rather than being controlled by them. He suggests that when stock prices are excessively high, investors should shift more funds into bonds, and when stock prices are low, they should increase their equity holdings. This contrarian approach, where investors act against prevailing market sentiment, is one of Graham's core investment principles. He emphasizes that understanding stock market history helps investors make rational decisions rather than emotional ones. Chapter 4. General Portfolio Policy. The Defensive Investor. This chapter outlines a practical investment strategy for defensive investors who prioritize safety, simplicity, and stable returns. Graham argues that a defensive investor should maintain a balanced portfolio, typically consisting of 50% stocks and 50% bonds. However, he allows for flexibility, suggesting that an investor can hold between 25% and 75% in either asset class, depending on market conditions. This strategy ensures that investors minimize risk while benefiting from market opportunities. Graham emphasizes that a defensive investor should focus on well-established companies with strong financial fundamentals. Instead of attempting to beat the market, defensive investors should aim for steady and predictable growth. He discourages frequent trading, market timing, or following stock market trends, as these often lead to unnecessary risks. Instead, he advises defensive investors to rely on diversification to reduce risk and ensure stability. One of the most important takeaways from this chapter is that simplicity and patience are key to successful defensive investing. Graham advises against speculative stocks, IPOs, or overly complex investment strategies. Instead, he encourages investors to stick to fundamentally strong businesses with proven track records. By following this approach, defensive investors can achieve stable returns without excessive risk or effort. Chapter 5. The Defensive Investor and Common Stocks. In this chapter, Graham explains how defensive investors should choose common stocks wisely to minimize risk while ensuring stable returns. He stresses that not all stocks are suitable for conservative investors, and that careful selection is necessary to build a low-risk, high-quality portfolio. The key criteria he suggests for stock selection include financial strength, earnings stability, reasonable valuations, and dividend history. Graham advises defensive investors to invest in large, well-established companies with a strong earnings history spanning at least 10 years. He recommends focusing on stocks that consistently pay dividends, as these companies tend to be financially stable and shareholder-friendly. Additionally, he warns against overpaying for stocks with excessively high price-to-earnings (PE) ratios, as such stocks often carry greater risk and limited upside potential. Another important consideration is diversification. Graham believes that even defensive investors should own at least 10 to 30 stocks across different industries to spread risk. By selecting a mix of high-quality, reasonably priced stocks, defensive investors can achieve steady returns while minimizing exposure to market volatility. Ultimately, Graham reinforces that the defensive investor's primary goal is to preserve capital and earn moderate returns without unnecessary risk. His advice remains consistent throughout the book: focus on value, avoid speculation, and invest with discipline. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. Benjamin Graham begins this chapter by focusing on the enterprising investor, someone willing to put in time and effort to achieve better than average returns. However, rather than immediately discussing what an enterprising investor should do, he first explains what they should avoid. He warns that many investment strategies that seem attractive can actually lead to significant losses. One of the major pitfalls Graham highlights is investing in low-quality bonds, often referred to as junk bonds. These high-yield bonds may offer attractive returns, but they come with significant risk. Another common mistake is speculating in the stock market, particularly through strategies such as trying to time the market, relying on stock tips, or buying into the latest investment fads. Graham strongly advises against investing in hot stocks, or IPOs, initial public offerings, as they are often overpriced and can decline sharply once the hype fades. Graham also critiques the practice of frequent trading, explaining that excessive buying and selling often leads to high fees and poor decision-making. Instead, he urges enterprising investors to adopt a disciplined, research-driven approach rather than chasing quick profits. He concludes by emphasizing that a truly intelligent investor focuses on intrinsic value and long-term stability rather than speculative trends. Chapter 7. Portfolio Policy for the Enterprising Investor. The Positive Side. Having outlined what to avoid, Graham now turns to how an enterprising investor should build their portfolio. He explains that while defensive investors focus on stability, enterprising investors can take a more active approach to security selection. However, this does not mean gambling on high-risk stocks. Instead, it means conducting thorough analysis to find undervalued securities that offer genuine investment opportunities. Graham suggests that enterprising investors look for bargain stocks, which are shares trading below their intrinsic value. These opportunities often arise when a company's stock price falls due to temporary bad news or market pessimism, despite the company having strong financials. He also discusses the potential of investing in special situations, such as mergers, acquisitions, or corporate restructuring, where the stock price may be undervalued due to market inefficiencies. Another key strategy is investing in companies with low price-to-earnings (PE) ratios and high dividend yields. This ensures that the investor is buying shares at a reasonable valuation rather than overpaying. Graham emphasizes that successful enterprising investors must have a rational, unemotional approach and be willing to conduct in-depth research. Unlike defensive investors, who should avoid unnecessary risks, enterprising investors must be selective and analytical, carefully picking investments based on fundamental value rather than speculation. Chapter 8: The Investor and Market Fluctuations. This chapter introduces one of Graham's most famous concepts, the Mr. Market analogy. He describes Mr. Market as a fictional character who offers to buy or sell shares daily at different prices. Sometimes Mr. Market is overly optimistic, offering high prices, while at other times, he is pessimistic, offering shares at a discount. Graham explains that intelligent investors should not let Mr. Market's mood swings dictate their actions. Instead, they should take advantage of market fluctuations by buying when stocks are undervalued and selling when they are overpriced. Graham warns against trying to predict short-term price movements, as markets are often irrational. Many investors panic during market downturns and sell their stocks at low prices, only to buy again when prices rise. This behavior leads to poor long-term results. Instead, he advises investors to remain patient and disciplined, recognizing that market fluctuations are normal. One of the biggest takeaways from this chapter is that volatility should be seen as an opportunity rather than a risk. Intelligent investors do not fear market downturns. Instead, they use them to buy high-quality stocks at bargain prices. Graham's key message is that investors should stay rational and focus on long-term value rather than short-term market movements. Chapter 9: Investing in Investment Funds. In this chapter, Graham evaluates the pros and cons of investing in mutual funds, investment trusts, and other professionally managed funds. He acknowledges that mutual funds are a popular choice for many investors because they provide diversification and professional management. However, he argues that most actively managed funds fail to outperform the market in the long run. Graham explains that many mutual funds charge high fees, which can significantly reduce returns over time. Additionally, fund managers are often influenced by market trends, leading them to buy overpriced stocks rather than focusing on long-term value. He advises investors to be cautious when choosing a mutual fund and to look for low-cost index funds, which track the market rather than trying to beat it. Another concern Graham raises is that investors often chase past performance, assuming that a fund that performed well in the past will continue to do so. However, historical data shows that most funds struggle to maintain high returns over long periods. His key advice to investors is to choose funds with low fees, a strong track record, and a focus on value investing. Defensive investors may benefit from mutual funds, but they should be selective in choosing the right ones. Chapter 10: The Investor and His Advisors. Graham addresses the role of investment advisors and stockbrokers, explaining when and how investors should seek professional guidance. He warns that not all financial advisors have their clients' best interests at heart. Many advisors and brokers earn commissions by encouraging frequent trading, which can hurt investors in the long run. He suggests that investors should seek fee-based advisors rather than commission-based brokers, as they are more likely to provide unbiased financial advice. However, he also argues that most investors can manage their own investments with enough education and discipline. Graham believes that self-education is the best tool for intelligent investing, and he encourages investors to develop their own understanding of financial analysis and market behavior. For those who do seek professional help, Graham advises them to choose advisors with a long-term perspective, ethical behavior, and a track record of conservative, value-based investing. Investors should be cautious of advisors who promise quick profits, complex strategies, or market-beating returns, as these are often unrealistic and speculative. The key message of this chapter is that successful investing does not require an advisor, but if one is chosen, they should be selected with great care. Intelligent investors must always be critical thinkers and not blindly follow the recommendations of others. Chapter 11. Security Analysis for the Lay Investor. General Approach. In this chapter, Graham introduces the concept of security analysis, explaining that while professional investors use complex financial models, an average investor can still evaluate investments using simple yet effective methods. Security analysis involves assessing whether a stock or bond is fairly priced based on its financial fundamentals, rather than market speculation. Graham highlights three key aspects of security analysis: the company's financial strength, its earnings stability, and its valuation relative to its intrinsic worth. He emphasizes that intelligent investors should examine financial statements to evaluate a company's profitability, assets, and liabilities. Understanding balance sheets, income statements, and cash flow reports can provide insights into a company's financial health. He warns against blindly following stock market trends, stressing that price movements alone do not determine a company's true worth. Investors should compare the market price to the company's actual earnings and assets before making decisions. Graham believes that investing should be based on rational evaluation, not emotion. A key takeaway from this chapter is that any investor, with patience and diligence, can conduct basic security analysis to identify strong investment opportunities. This process helps avoid speculation and ensures investments are based on real value rather than market hype. Chapter 12. Things to consider about per-share earnings. Graham dedicates this chapter to earnings per share, EPS, explaining how it is often misinterpreted by investors. He warns that EPS figures can be misleading and should never be used in isolation when evaluating a stock. Many companies use accounting tricks to manipulate earnings, making them appear more profitable than they actually are. One major issue is that companies can smooth out earnings by shifting expenses and revenues between different financial periods. This can create the illusion of steady growth, even if the company's actual financial performance is unstable. Graham advises investors to look beyond one-year EPS figures and instead examine long-term earnings trends over 10 years or more. He also emphasizes that high earnings growth does not always justify a high stock price. Many investors overpay for stocks with rising earnings, assuming that the growth will continue indefinitely. However, companies often struggle to maintain high growth rates, leading to disappointing returns for investors who buy at inflated prices. Graham's key lesson in this chapter is that earnings per share should be analyzed critically and in the context of a company's financial health, competitive position, and industry trends. Blindly chasing high EPS growth without understanding its sustainability can lead to costly mistakes. Chapter 13. A comparison of 4 listed companies. In this chapter, Graham provides a real-world comparison of 4 different companies, demonstrating how security analysis can help investors distinguish between strong and weak investments. His goal is to show that market price does not always reflect the true value of a company. Through this analysis, Graham illustrates that companies with stable earnings, strong balance sheets, and consistent dividends tend to be better long-term investments than highly speculative stocks. He highlights how some businesses appear strong based on their stock price performance, but their fundamentals reveal weaknesses such as excessive debt or inconsistent earnings. One key takeaway from this chapter is that overpriced stocks, no matter how strong the company seems, can still be bad investments. Investors who ignore valuation and chase high-growth stocks at any price often suffer losses when the stock price corrects. On the other hand, companies that may be temporarily undervalued due to market pessimism often present great buying opportunities. Graham's comparison underscores the importance of rational, fact-based decision-making. By studying companies' financials rather than simply reacting to stock price movements, investors can identify solid investment opportunities while avoiding overpriced, risky stocks. Chapter 14. Stock Selection for the Defensive Investor. This chapter is specifically aimed at the defensive investor, outlining criteria for selecting stocks that offer safety and reliable returns with minimal effort. Graham believes that defensive investors should follow a systematic approach to stock selection, ensuring that their portfolio is well diversified and consists of fundamentally strong companies. The key characteristics of good defensive stocks include large, well-established companies with strong financial health. Graham advises choosing companies with a long history of stable earnings and a proven track record of paying dividends for at least 20 years. He argues that dividends are a crucial indicator of a company's financial discipline and a source of steady income for investors. Graham also stresses the importance of valuation. Defensive investors should avoid stocks that are overpriced relative to their earnings. He suggests a moderate price-to-earnings (PE) ratio, ensuring that investors do not overpay for growth. Additionally, he recommends avoiding speculative or high-volatility stocks, as they introduce unnecessary risk. The chapter reinforces Graham's belief that defensive investing is about patience, discipline, and long-term focus. By sticking to high-quality, fairly valued stocks, defensive investors can achieve stable and satisfactory returns without exposing themselves to unnecessary market risks. Chapter 15. Stock Selection for the Enterprising Investor. Unlike the defensive investor, the enterprising investor is willing to put in extra effort to achieve higher returns. In this chapter, Graham lays out a disciplined approach to stock selection for investors who are ready to conduct in-depth research and take calculated risks. The enterprising investor should actively seek undervalued stocks, companies that are temporarily out of favor or trading below their intrinsic value. These stocks often provide great investment opportunities, as their market prices do not reflect their true worth. Graham encourages enterprising investors to look for stocks with low price-to-earnings, PE ratios, and strong balance sheets, ensuring that they are not taking on excessive risk. He also highlights special investment situations, such as companies undergoing mergers, restructurings, or temporary difficulties. These situations often create mispriced stocks, allowing enterprising investors to buy shares at a discount. However, Graham warns that success in this strategy requires deep research and a strong understanding of financial data. Another important aspect of enterprising investing is avoiding overpriced stocks, even if they seem promising. Graham warns that many investors fall into the trap of buying popular stocks at high valuations, only to suffer losses when the market corrects. Overall, Graham advises enterprising investors to be selective, analytical, and patient. While they can achieve higher returns than defensive investors, success depends on sticking to sound investment principles and avoiding speculation. Chapter 16. Convertible Issues and Warrants. In this chapter, Graham discusses convertible securities and stock warrants, explaining their potential benefits and risks. Convertible securities are bonds or preferred stocks that can be converted into common stocks at a predetermined price. They are attractive to investors because they offer the safety of bonds while allowing potential upside if stock prices increase. However, Graham warns that most convertibles are issued at a premium, meaning investors often pay too much for the conversion feature. While convertibles may seem like an attractive compromise between stocks and bonds, Graham argues that they are often structured to benefit issuing companies rather than investors. Many companies issue convertibles when their stocks are overvalued, meaning investors are unlikely to gain much from conversion. Moreover, these securities often provide lower yields than standard bonds, making them less attractive from an income perspective. Graham also discusses stock warrants, which give investors the right to buy shares at a fixed price in the future. While these instruments can be highly profitable in a bull market, they are speculative and should generally be avoided by defensive investors. He concludes that most investors are better off sticking to straightforward stock and bond investments rather than complex hybrid securities, as these instruments often introduce unnecessary risks. Chapter 17. 4 Extremely Instructive Case Histories. Graham presents 4 case studies of companies to illustrate common mistakes and lessons for investors. He examines how investors often fall into traps by overpaying for stocks, failing to analyze financial statements, or getting caught in speculative frenzies. One case study examines a once promising company that had strong earnings growth and high investor enthusiasm, yet it ultimately collapsed due to excessive debt and unrealistic profit expectations. This case highlights the dangers of overconfidence in growth stocks. Many investors buy stocks at high prices, assuming their growth will continue indefinitely. But when earnings slow down or decline, stock prices crash, leading to massive losses. Another case study involves a company that was deeply undervalued due to temporary setbacks. While the stock was ignored by most investors, those who focused on its intrinsic value rather than short-term problems were able to achieve excellent returns. This demonstrates Graham's philosophy of value investing. Investors should buy companies based on fundamental strength rather than market sentiment. These case histories reinforce the idea that successful investing requires patience, thorough research, and discipline. Investors should avoid overpriced stocks and speculative trends while looking for stable, well-managed companies trading at reasonable valuations. Chapter 18: A comparison of 8 pairs of companies. Graham further explores the principles of value investing by comparing 8 pairs of companies operating in the same industry. His goal is to show how 2 similar businesses can have vastly different investment potentials based on their financial fundamentals and valuation. One major lesson from this chapter is that market prices often do not reflect a company's true worth. Many investors assume that just because a company's stock price is rising, it must be a great investment. However, Graham demonstrates that some highly valued companies are financially weaker than their competitors and may be overpriced due to hype and speculation. On the other hand, some less popular companies, despite having strong earnings and sound balance sheets, remain undervalued due to temporary market pessimism. Graham encourages investors to look beyond stock price performance and focus on financial statements. He advises against investing based solely on past performance, industry reputation, or market trends, as these can be misleading. Instead, investors should evaluate companies based on profitability, debt levels, dividend history, and price relative to earnings and book value. This chapter reinforces the idea that intelligent investors do not simply follow the crowd. Instead, they analyze businesses thoroughly, compare their financial health with competitors, and seek undervalued stocks with strong long-term potential. Chapter 19: Shareholders and Management's Dividend Policy. Graham discusses the relationship between shareholders and corporate management, with a particular focus on dividend policies. He argues that a company's dividend decisions reflect its financial health and treatment of shareholders. A well-managed company should reward investors by paying regular and sustainable dividends. However, some companies choose to retain all their earnings rather than distribute them to shareholders. While reinvesting profits can sometimes lead to growth, Graham warns that many companies fail to use retained earnings efficiently. Instead of reinvesting in productive business activities, management may spend excess cash on acquisitions, executive bonuses, or risky ventures that do not benefit shareholders. Graham advises investors to be skeptical of companies that withhold dividends without clear, justifiable reasons. He suggests that shareholders should evaluate whether a company's retained earnings are actually increasing long-term value. If a company has a strong history of using retained earnings to grow profits, it may be a worthwhile investment. However, if retained earnings do not lead to improved financial performance, investors should question management's decisions. This chapter teaches that intelligent investors should prefer companies with shareholder-friendly management. If a company consistently reinvests profits wisely or pays reliable dividends, it is likely a sound investment. But if management is hoarding earnings with no clear benefits to shareholders, investors should be cautious. Chapter 20: Margin of Safety as the Central Concept of Investment. This is one of the most important chapters in The Intelligent Investor, where Graham introduces his famous margin of safety principle. He defines the margin of safety as the difference between a stock's intrinsic value and its market price. If a stock is trading significantly below its true value, it provides a margin of safety that protects investors from errors and market fluctuations. The margin of safety principle is based on the idea that no investor can predict the future with complete certainty. Even the most carefully analyzed investments can go wrong due to unforeseen events or economic downturns. By purchasing stocks below their intrinsic value, investors reduce their risk and increase their chances of earning solid returns even if the company faces difficulties. Graham compares the margin of safety to a bridge built to hold more weight than necessary. A well-constructed bridge should be able to withstand more than the maximum expected load. Similarly, A well-chosen investment should have a built-in cushion to protect against market downturns, economic recessions, or business misfortunes. He emphasizes that margin of safety is the key to successful investing. Instead of chasing hot stocks or speculative bets, intelligent investors focus on buying high-quality companies at discount prices, ensuring lower risk and greater long-term profitability. That's a wrap on The Intelligent Investor. Graham's wisdom teaches us that smart investing isn't about luck. It's about discipline, patience, and knowledge. Whether you're a defensive investor looking for stability or an enterprising investor seeking growth, his principles can help you navigate the stock market with confidence. If you found this summary helpful, don't forget to like, share, and subscribe to Simplified Whispers for more insightful book breakdowns. Let us know in the comments, what's your biggest takeaway from this book? See you in the next one.